Hello, Business 630 students. This is Professor Hassey. It's week 3. Today's date is Tuesday, June 21st, and we begin our third week of our summer session here in corporate finance, concluding capital fundraising. And we're going to talk about stocks today and conclude our discussion of bonds. Have a brief video to show you in that regard. It's kind of a corny video, but again, it gives some of us some background into stocks and bonds if we haven't had it in the not too distant past. Also, we're going to talk about what's ahead in our course here in week 3. We have our case number 1 study for this week, which is due on Sunday, June 26th. It involves a credit review or a risk analysis review of a company that you have selected. And we have some great companies that have been selected by our group here, wide-ranging different types of markets and industries. So I'm looking forward to those. And then we talk next week, we begin our study of capital budget analysis, one of the key areas of corporate finance to determine the return on an investment in capital assets. And we're going to be doing a spreadsheet format case next week, which we posted a week from this week on June 27th. But you have 2 weeks to do that case, 2 weeks to do that case. So don't anybody panic. Also next week, with week number 4, I'll be scheduling and making available for you, all the students in our course, to have a one-on-one session with me, the professor. This is mandatory. It's part of your class participation, where we take 10-15 minutes and meet during week number 4 to talk about the class, make sure you're all doing well, and have any questions or concerns of me about our format for this summer. So we'll talk more about that later on this week with my weekend update video, but we will be meeting individually with me next week in week number 4. So first of all, let's begin our discussion today with take a look at where we stand in our Blackboard. So let's take a moment to take a look at that. Okay, here's our Blackboard site, which hopefully you all are becoming familiar with, especially now that we're getting into our casework. First of all, again, remember that any links or any emails that I put up are always put into the course announcement file folder, the latest emails that I send out to the class. Also, all the latest links to Zoom and to our videos are all located in one location in the Zoom and YouTube links area. There's that in. Also, in our discussion forum, if you have any questions or concerns about our course, type it into the questions and comments section and I will answer it for you. Our case study has been posted, as you know, and it's due this Sunday. It's a APA formatted paper. And you are to do a risk analysis, credit analysis of the company, and you're going to be doing some capital asset pricing work and all that sort of thing. So get back up to speed on some of our basic finance skills. And then here is week 3 that we're in. Again, we have this video, which we're going to watch just a moment, bonds versus stocks, some descriptions of stocks from our textbook, a PowerPoint from our textbook, some key parts of the capital asset pricing model and the definition of that, which you're doing in case number 1. Might want to take a look at that, and some other analysis that we're going to be doing this week. So please keep up to date with your Blackboard review if this is where the online information is. And again, if you have any questions or get confused, be sure to let me know. So let's take a look at this video describing bonds and stocks.
So we now know that there are 2 ways that a company can raise capital. It can do it by borrowing money, which is debt, or by selling shares of itself, or essentially allowing other people to become partial owners of it, and that is equity. And these directly translate into securities that you're probably familiar with, but maybe you didn't have a more exact idea of what they are. You know what equity securities are. And just so you know, what is a security? A security is essentially something that can be bought and sold that has some type of claim on something or some type of economic value. So a security in the equity world is a stock, and a security in the debt world is a bond. Let me explain that. So let me just draw the balance sheet for for the fictional company. It was pointed out to me that socks.com actually is not a fictional company, that someone is indeed selling socks online. So, which I, by the way, think is a great idea. So let's see. I have my assets right here. These are the assets of the company, but that's not what we're worried about right now. Assets, and let me draw the equity of the company. Right, this is maybe shares that they sold, and so let's say that they have, I don't know, that there are 10 million shares. 10 million shares. And then we have the debt. The debt of the company, or the liabilities. There are other liabilities other than debt per se, but that's all we'll worry about right now. This is the debt. I'll do it in brown. We have the debt. The debt. And maybe the assets, let me just think of a good round number. The assets are $10 million in assets. And let's say our debt is, I don't know, $6 million. And then what's left over for the equity, right? And the way you have to view it is, okay, if I have $10 million and I owe people $6 million, what's left for the owners of the company? Well, the owners of the company will have $4 million left. $4 million left. And it'll be split amongst the owners of the company. And there's 10 million individual shares. So if every person who has one of those stock certificates will own 1/10 millionth of this $4 million, or essentially, what is it, 40 cents a share or something. So anyway, this is, and I think you're familiar with this already, this is essentially stock. Right? When we say 10 million shares, that's 10 million shares of stock. I could just draw I could draw 10 million stock certificates. And I guess whatever the ticker symbol is. And there could be 10 million of those. Now, debt is interesting. There's a lot of ways you can raise debt. And actually, there's a lot of ways you could raise equity. It actually doesn't have to be with selling. Well, for the most part, you are selling stock. You could maybe think of some other way. And we'll talk about other forms of equity, preferred stock, and all of that. But in the simplest level, you're really always selling stock. Debt's a little different. Debt could be just in the form of a bank loan. So, this could be a bank loan, where you literally go to the bank and say, hey, I need $6 million. And they say, okay, here you go, and we'll give it to you for this interest. And you have to pay back the money above and beyond the interest over this time schedule. So, not too different than maybe a mortgage. Or they might say, okay, you pay the interest for 5 years. And at the end of the 5 years, you also have to pay the principal amount. So you have to pay the whole $6 million. So you maybe have to come up with a new loan or something like that. So that would just be a bank loan. There's other things that are revolving lines of credit, which is kind of like a company's, I guess a company's credit card to some degree, that it doesn't have to use it, but if it does, that's kind of debt the company takes on. But kind of the one that people always talk about, I guess in the same phrase, is bonds. So bonds are essentially, you are borrowing from the public markets again. You're borrowing from a bunch of people. So what you do is you have these 6 million, let's say the $6 million, and it could be divided into, let me think of a good number. You could divide this into 6,000 bond certificates, right? So this could be 6,000 bond certificates. Let's see, and 6 million divided by 6,000, right? That's 1,000, right? So it could be 6,000 times $1,000 bond certificates. And let's visualize what a bond certificate could look like. So that could be a bond certificate, and its face value, and sometimes they'll call it the par value or the stated value. It'll say, let's call it bond from company XYZ, and its face value is $1,000. So it's essentially, this is an IOU from company XYZ. If I were to hold one of these, if Sal had one of these sitting on my desk right now, that tells me that company XYZ is going to pay me $1,000 at some future date, right? And that future date is at maturity. So it's going to pay $1,000 at maturity. And you say, oh, well, Sal, that's all good, but what about the interest in between? And there's two ways to think about this. Maybe maybe they're going to pay me $1,000 in the future, but I only have to give them $500, right? So if you think about it, there's automatically interest accruing in that, right? If I gave them $500 and then 5 years later they pay me $1,000, they're essentially paying interest, right? They're paying me more back than I gave to them. And in future videos, we'll actually do the math of how to figure out that type of interest. And in that situation where they're not kind of paying me interest as they go, this would be viewed as a zero coupon bond. And I know I'm throwing out a lot of terminology, but it'll all make sense to you in a second. So zero coupon essentially means they're not paying interest until they pay off the whole loan. And then they might the interest will be implicit in the whole value of the amount. And I kind of jumped the gun a little bit, but coupon is essentially a regular payment on the bond that the company makes, in this case XYZ will make. That is essentially, you can almost view it as a kind of interest. But if you really had to figure out the interest that you're getting on the bond, you would actually have to figure, and I'll do maybe a whole playlist on bond mathematics. You would have to figure out, it's based on the coupon, what you gave them, and then what they're going to pay you and when they're going to do it. So it's a little bit more complicated than just saying, oh, look at that, they're giving a 6% coupon, which essentially means, twice a year they're going to give me 3% of the value of my bond. So just a big picture, both of these things are traded. This is a stock, it's traded on exchange, and you're probably familiar with that. If you go to Yahoo Finance, you type in the ticker symbol and you get the price for that day. Bonds are also traded. Unfortunately, it's not as easy to get a quote on a bond. Usually you have to have a Bloomberg terminal of some type. You can't get it on Yahoo Finance, and I think that's by design by bond traders because they probably don't like the transparency there. But it is just like a stock. It is a security. It is traded. There is a price. But then there's a very fundamental difference in what kind of the holder of the bond is doing. In a bond, you've essentially, if I'm holding a $1,000 bond, that means that I've lent some amount of money to the company, and it'll be in this part of it. And as long as the company doesn't go bankrupt, they'll pay me some interest and pay me my money back. When I own a stock in the company, right, I own a share of the equity as opposed to a share of the debt, which was the case with the bond. When I own a share of the equity, the company's not promising to pay back anything. It's just saying, look, you are a part owner of this company, and anything that any of the owners get, you'll get. So if this company becomes worth a lot, if we start dividending out things to the shareholders, then you'll get that. If the company gets sold by someone and pays X dollars per share for it, you'll get that money. And if the company goes bankrupt, you'll also go bankrupt. And that actually leads to an interesting question. If the company goes bankrupt, and let's say, actually, let's do the example right now. Let's say the company goes bankrupt, right? And I'll do a more in-depth example of this. The question is, let's say the company goes bankrupt and people decide that it's not operational anymore, that it just can't do business. Because there's actually two types of bankruptcy. There's one where you say, oh, the business is good, and it just can't pay off its debts, so we have to somehow restructure this side of it. And then the other type of bankruptcy is liquidation, where they say, you know what, this business doesn't even make sense to operate anymore. Let's just sell off all of the assets. So the question that I'll leave you with in this video is, what happens in a situation where you enter bankruptcy? People want to liquidate the assets, and let's say when you liquidate the assets, there's only $8 million of assets. So the question is, who do you think is going to eat that $2 million? Is it going to be the debt holders or the stockholders? Who is going to lose their money first? Or you can almost say, who is more senior when it comes to actually getting their money back? And I'll leave you with that maybe to the next video or a future video that I'll do on bankruptcy. See you in the next video.
Well, to answer that question of the video, what would happen to the $2 million that you lose in the dissolving of the company? That would be taken from the value of the equity position. The debt position has to be taken care of. It is the stockholders that assume the risk of the bankruptcy and the loss of capital. So that leads us into our next conversation. Why would you pick a bond over a stock? Well, in a bond, you have guaranteed income, guaranteed payments. If the company goes in default, they have to sell assets to pay you. But the bad thing about bonds is there's not that much high yield. You're yielding whatever the yield is on credit in the current market conditions. Right now, the average yield on high quality corporate bonds right now is about 5.5–6%. Whereas you can invest in the stock market, not the last couple of weeks though, but you can invest in the stock market and earn 10 to 20%. The problem is that's not a sure thing. a bond investment or a bond capital fundraising is a sure thing for the investor. They're going to get paid. Stock, there's a lot more risk. There's a lot more return maybe, but there's a lot more chances of not getting the return you want. So how do you determine that? How does a company determine whether they should finance via debt like bonds or stocks? And why are we concentrating so much on bonds? Because bonds is where the big money is. Most banks cannot lend over maybe $150, $200 million to one single company. It can't be done because of the risk involved to naturally the depositors of the bank. When companies want to borrow a lot of money from banks, they have to put deals together, multiple banks putting deals together or financing together. So to avoid all that and avoid all that hassle, why don't I just go out into the bond market and borrow $300 million, $500 million? There you can borrow in one full issue the capital you need. Now, you still have to make sure you provide a prospectus and all the financial data and all that, but bond financing is for big money. And that's why it's called in corporate finance. Corporations get most of their big money capital from the issuance of credit debt supported by bonds, where the bond is usually paid non-amortized bond, where you just pay interest until maturity. And how they can get away with that is because of the credit and the assets as collateral behind that debt issue. That's why you and I, when we have to go out and buy a car, get a car loan or a mortgage, we have what is called amortized loans. What are those? We're paying interest and principal with every payment. We don't have the collateral or the credit to ensure the risk to the lender that we're going to pay it back. So they naturally charge us interest and principal with every payment to ensure that their risk is covered. And that's why we have to pay monthly payments amortized with our individual lending. But for corporations, they can avoid that because of the collateral and the credit they have behind those issues. So let's talk about stocks. There's two ways of getting money in a stock: dividends, and hopefully the price of the stock goes up. Now, if you would ask Mr. Hassey about that today on June 21st, 2022, my stock portfolio is down 21% this year of 2022. Ouch, not good. Now, hopefully, I'm not in any hurry with that stock. And as the case today, the market was up big time and I earned some of that back. But stock goes up and down. And in this year, 2022, with the fear of coming out of the pandemic, the fear of inflation, the fear of uncertainty in regards to our social and political atmosphere in the country and the world, has caused the equity markets to drop. So I've taken a loss. Now, if I needed that money today, that's not very good. I probably wouldn't have invested in those stocks. I would have invested in bonds or invested in less volatile investments, like even money market. But since this is my play money and I'm kind of trying to see if I can make some money in the long term, even though I'm down 21% this year, I was up 24% in 2021. So I'm still kind of ahead, but this year, not so good. But that's where you make your money in the stock market, is in the stock price going up. Dividends, somewhat. So when I talk about dividend yield, it's taking the dividend that a stock is paying. And granted, some companies do not pay dividends on stocks. But if I take this dividend, let's say in this case, it's $4 a share, and my stock price, I purchased it at was $20, then I'm getting a yield of $4 divided by 20, or 20%. That's my dividend yield. That plus whatever the stock price goes up gives me a total capital gain, a total return on the stock. Dividend plus stock appreciation. So for every investor, you want to make that total return. For every company going out and issuing stock, they want to make sure they not guarantee, but they can prove to the investor community that they can go out and get those desired returns, so they will give you the money to invest in their company. Remember, the stock market is for stock already issued. The companies have already got their money, in some cases years ago, with an IPO, a public auction of their stock. The stock that you buy and sell in the market on Robinhood or through various brokers or through your 401k or through your IRA, that's stock that has already been issued and the company's already received your money. You are now just buying or trading the stock to other people who want to buy or sell this stock. And that's the market. And how the market goes up and down is the supply and demand of that company in the market. If a company is doing well, there's going to be more people wanting to buy the stock. That will force the supply and demand curve up. If a company is doing poorly or the world around them is doing poorly, like the last few weeks, the stock price is going to go down. Thus, there's going to be more sellers than buyers. The price will drop. It's strictly a supply and demand. And what creates that supply and demand is the performance of the company, yes, but also the performance of the company in their industry, amongst their competitors, and the state of the world affairs currently. A lot of people are pulling money out of the stock market these last few days. Why? They're taking their profits and they're putting them in safer investments. Maybe a money market account, maybe gold, maybe real estate. They're taking their profits and going to a little bit more safer investments because they're uncertain about the future. So now today, Tuesday, the stock market went up. Why did it go up? Because those people who have been sitting on the sidelines see that the stock price has gone down. Oh, now I can buy that stock a little bit cheaper. I'll get back into the market. So today there are people replacing those who sold yesterday, getting back into the market. Makes your head spin, but that's the market. And that's where corporate finance is centered around. How a company represents themselves in the market, in their stock price. Basically, a stock price is a public relations tool for a company. Well, our stock price is up for the last 50 years. Look at what Elon Musk has done with Tesla for the last couple of years. Tesla stock has been overvalued, overpriced, and he's been saying, see, that shows you what a great company we got. It's the way the market perceives the company. So one of the key factors I want to get out of this is what are the determining factors of stock? Naturally, if a company pays and distributes dividends, but naturally it's the supply and demand performance in the market of the stock. And we have a calculation that's done many times in the market. It's called the constant growth model. What is the true value? In many cases, they call it, and you might have heard this in other classes, what is the intrinsic value of a stock? The intrinsic value is, hey, the stock price is currently trading on the market at $30, but I think its real value is $27. That's its intrinsic or real value. And that intrinsic or real value is determined by what is called the constant growth model. You take the dividend, you divide it by the expected return, and you minus the expected growth that the company says they're going to have. Now, what that means is, and let's look at this example here. Let's say the company is paying currently for the next year. And remember, every publicly traded corporation, every quarter has to put out an estimate of what they think their company is going to be doing growth-wise, profit-wise, stock price-wise over the next 12 months. It's required by law by the Securities and Exchange Commission. So I think I'm investing in this company, stock A, all right? And stock A, currently say they're going to be paying a 54-cent a share dividend over the next year. And let's say I'm going into the market, my own personal expectations is for a 9% return on this stock. The company says over the next 12 months, we expect a 7% return or growth of our company, a 7% growth. Well, if I use that formula, 54 cents divided by 9% minus 2%, I will get the figure $27. Now, what does that mean? Well, that means based on the expectations in the market of the growth and my expectations of a return divided into the income that they anticipate generating, that in order to achieve that desired growth and return, stock price should be at $27 a share. So I go to my broker and I say, hey, dudes, what's stock A trading at? And they say it's trading at $30 a share, closed today, Monday, June 21st. It closed at 30, and I think its price should be 27. What should I do? Stay the hell away from that stock. It's overvalued in the market. It's overvalued. The market thinks the stock is worth 30 when it's really worth $27 based on the estimates of expectations into the next 12 months. Stay away from it. Now, vice versa. If I called up my broker and the broker said, yeah, Rick, this stock is now at $20 a share, I would tell my broker, buy. Place an order to buy tomorrow morning. Why? Because at $20 a share, I'm buying a stock that really has a value over the next year, hopefully, of $27 a share. It's undervalued. I should buy. And that's how the market works. Whenever you get a phone call from a broker or some dude says, hey, you should get into this company, it's because the expectations are great enough to offset the current anticipated market price of the stock in the current market, overvalued or undervalued. And the constant growth model is one way of determining that. I can't tell you how many stockbrokers and investment managers use this model to tell and to look for trends about certain stocks. Another area to look at is this, which we'll be discussing greatly next week, is to consider, and this is one of the discussion points of our text, is what is the cost of equity? What is, going back to this problem we just used, how did this investor come up with a 9% expected return? How does Rick Hassey say, I expect to get 9% or I demand 9% return out of the stock this next year? Well, I do a calculation like this. Now, this is not the one per this 9%. This is another one. But I do a combination of determining the risk and value of the stock in the current market. And it's called the capital asset pricing model. And the capital asset pricing model is taking the risk-free interest rate in the market, which is the 10-year United States Treasury yield, plus the market premium, which is the current market return of the S&P 500 in the market, minus the risk-free rate. That's called the market premium. And that market premium is multiplied by the current beta or risk in the market of this company. So just using this example here, the numbers are a little bit dated, but we'll do this. The risk-free rate always has a beta of 0, and currently the risk-free rate is 1.75%. The S&P 500 market return with a beta of 1, which is average beta, is 8.5. And the beta of this company is a little bit riskier, 1.50. Remember, beta is a standard deviation regression analysis comparing a rolling 4-quarter average going back 4 years, that's 16 quarters, comparing the return on this company versus the market. And in this case, the regression and standard deviation is a little bit wider, so it's a little bit riskier. Thus, the beta is 1.5. That's why I ask you to find the beta in your companies in that very first week, because you're going to use this calculation in this capital asset pricing model in one of the first questions on the case. What is the risk determination of the expected return of the company? Well, if the beta is 1.5, then I plug it into the formula. 1.75% risk-free rate plus the market premium, which is 8.5 minus 1.75. That's 6 and 6.75, I believe, times the beta of the company, 1.5. Add the two together, I get 11.88%. That's pretty high. So in other words, the expected rate of return on this company today in this market of 0 risk, average risk, and the risk of this specific company, I expect to earn 11.88%. If I think the company can achieve that, I'll buy the stock. If I don't think the company can achieve 12% return in the next year in this market, in this post-pandemic world of high inflation, I would stay away from the stock. But companies track this on a quarterly basis because how is their company attractive in the capital markets to go out and raise more capital? Even lenders, banks, bond markets look at the cost of equity return analysis of the capital asset pricing model. If that is fluctuating wildly, they'll say, this company is a little bit too risky for us. I don't even think I'm going to lend them money. So this is a key determinant of capital fundraising in corporate finance, is understanding the cost of equity. What the next topic that we'll talk about on Friday in our weekend video and into next week is how does this all apply to the cost of capital? Combining the cost of debt and the cost of equity in the specific capital structure of a company to determine what it's costing them to raise capital as a whole. The cost of equity of Chapter 7 of stock is just for equity, issuance of stock. But it's still the major determinant of ability to raise capital in the market. So that's a great review, not by me, but overall, a great review of stocks and how they implicate corporate financing. Because the risk in the market is expectations. High expectations mean higher risk, higher interest, and that'll drive the stock price or the expectations of the company through the constant growth model, and in also going out and raising total capital using the weighted average cost of capital analysis. And we'll talk about that at the end of this week and in next week. So that's a great review there of stocks and bonds and how it applies to capital finance. So as I said, I'm beginning to pick up the pace a little bit now with work. So please keep in tune with this class and know what's going on. We have a case study due in an APA format paper due this weekend. We have another case due in 2 weeks that'll be distributed next week on a spreadsheet format for a capital budget analysis. We're going to begin our capital budget analysis. And also next week, we're going to have some individual talks with the Professor Hasse, one-on-one, and we'll set a schedule, and I'll post that schedule over the weekend. You pick a date and a time, and I'll see you on Zoom to talk a little bit about the course going into our halfway point. You believe this? Next week, we're at the halfway point of this class. Amazing. And then to top all that, on Friday of next week, you get your case study paper topic, which is due the last day of class. And I'll talk more about that next week. So a lot going on. Keep in touch, and we'll see you at the end of this week with another video. If you have any questions, be sure to let me know, and especially in regards to case number 1. Thanks, everybody. Have a great week, and we'll see you next time. Bye-bye.